Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend, rolling through all the latest news, rumors, speculation on everything going on in the mortgage industry. And as always, pleased to be joined by my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you.
Nice to see you too.
And this week in the co-pilot seat, from our great and long-term partners at Curinos, their head of real estate and consumer lending, Brandonn Dukes. Brandon, great to see you, bud.
Nice to be on here, Rich. Thanks for having me.
Curinos, one of the partners at TMC, used to be Informa, goes all the way back to the beginning, like before we had any members. So long-term partner of ours, and really, you guys are central to a part of the industry and a trend right now that lenders are so interested in. That is just actionable data. Ahead of your time there, before a lot of lenders were really utilizing data to drive decision making, to use it to attract, retain, grow more profitable customer relationships. You guys have so many clients of TMC, members of TMC that are clients of yours, and just do such a great job. And I'm really excited to have you on because there's so much to get into just as it relates to data and margins and changing statistics and demographics of the mortgage industry that are really central to the minds of leaders right now. So really appreciate you joining us this week.
Again, thanks for having me. I think you hit the nail on the head. Having that actionable data in a timely fashion is something that we've been able to really provide for our clients, and a lot of them hopefully watching us today. So thanks for the time.
If it's lock fund percentages or cycle time changes, market growth, jumbo rates, how you're pricing in the market relative to your peers, all stuff you guys do a great job helping the members on, and excited to dig into each of those a little bit more as we get into the show here.
Sounds great.
All right. Well, Rob, only one way to start the show today. I mean, Southwest.
No. There's all kinds of ways to start the show, Rich. Let me tell you how I'm going to start the show. So I received an email this morning asking me ahead of the show, ahead of anybody knowing about Brandon being on. He said, actually, this was a gal. A gal said, does Rich ever bring anybody on the show who has a head of hair, an actual head of hair? And so I said, oh, I'm sure Rich doesn't discriminate against people with hair. So I see that I misanswered that email. The second thing is, first of all, I'd like to take a step back. So I grew up in the Santa Clara Valley, south of San Francisco, and my family had some orchards in a town called Cupertino. And it used to infuriate my family when somebody would pronounce the town Cupertino. And my mom would always say, well, you don't say Cupid, you say Cupid. So I admire Curinos to maintain that pronunciation of the CU. So Brandon, congratulations on that. So Rich, what were you going to ask?
Thank you.
Southwest is bringing drinks back.
What's that?
I didn't know until I saw it in your newsletter this morning. It made my Friday. I'm a Southwest loyalist, and to me, it's a sign that things are hopefully returning to normal. So very uplifting.
Yeah, absolutely. I think they're returning to normal. As we talked about, we were in Nashville, and before that, I'd done some traveling to Southern California and to Florida. And when I go through the news headlines, and I've told people this that I'm sure are listening in, COVID is no longer driving the headlines. Now, granted, no news is good news, right? There's always Ukraine to worry about, and the price of energy to Europe from Russia. And, I heard today, actually, it's a line I'm going to use tomorrow, that the U.S. bobsled team has named their bobsled the Joe Biden because nothing drives things downhill faster. Anyway, I butchered that joke, but it's nice not to see COVID. It's nice not to hear people talking about bodies stacked like cordwood in the street from the pandemic. It's nice to see Southwest bringing back alcohol. as bad as that sounds, I think we are returning to normal, and there's so much pent up demand from this economy that it's driving inflation higher. It's driving the cost of McNuggets higher, chicken nuggets in general. Inflation is on fire, and the Fed is viewed as behind the eight ball and not seeing this. And it's hard to see anything really in a pandemic, but it's really an interesting time to be watching the economy and unfortunately see how it impacts interest rates and our industry.
The jobs report this morning, incredibly positive. 476,000 new jobs in January, way higher than expectations. December was revised up to 510,000 new jobs. Unemployment rate actually ticked up 0.1, but we've talked about the goofiness between the misconnects between those two numbers. Hourly earnings were up, everything beat. But what it did was the 10-year I saw just a little bit ago, $1.93, $1.94. We are approaching that magical 2% mark on the yield in the 10-year. We know 30-year fixed rates typically trade a couple hundred basis points above the 10-year Treasury yield, and that's really the economy is firing on all cylinders. It really is. But the Fed's previous actions and the future ones that are coming, it's driving interest rates up quickly. I think the combination of those two things, oh my God, it's transitory, we're going to do nothing, and now things are firing like crazy. So it really, though, I think it's, and I bring that up because it's going to define a lot of what we talk about today with a higher interest rate climate. So
I agree. I think that as rates have gone higher here, and hang on, I'm going to snag. Sorry, Brandon, but here she is. There's Myrtle.
Nice.
The legendary Myrtle.
I have long wanted to meet Myrtle.
There's Myrtle. You'll see one ear is flat because that ear doesn't work anymore. But this ties Brandon right into what Curinos does, because we're talking about unemployment and we're talking about people working from home. And I mentioned it today that I'm still hearing these hybrid models that are out there, and managing a workforce, an originator workforce, whether they're account executives or loan officers, whether you're a bank or a mortgage bank or a credit union, managing them from afar and trying to measure what they're doing, and not so much measuring the amount of time they spend playing Tetris on their laptop, but the amount of time that they're doing the things that they need to do, and then measuring how you stack up against competitors. So I was going to ask you if your business has changed with this, first the shift to work from home, and then the shift kind of back into a hybrid, or maybe some people are still working from home, some people in the office. How has that changed you guys and what you're producing for your clients?
Well, we've had, and I apologize, both of you. I am from the South, so I say Curinos, like curious, instead of Curinos.
Okay.
I think I've heard it pronounced that way, but Curinos, curious. And what you just actually does make me curious, because I've had to expand my workforce quite a bit during the pandemic. And so all we could do was hire remote. And so even if we wanted everybody to come back into the office now, there's really not a lot of offices to join because we hired all over the country. But it has enabled us to kind of run seamlessly throughout the lows and highs of the pandemic, where some people started going back into the office, and then no, we have to put a pause on that. It hasn't impacted our ability to service our customers or changed much of what we do. A lot of times we would work with them remotely anyway. A lot of times have the pleasure of coming to their office and walking through our platform or getting them onboarded. But a lot of it was already done remotely. And so it was pretty seamless for us. And we're pretty comfortable with it.
But in terms of the competitive nature of our business and being able to quantify things, which is what you guys excel in, in terms of measuring the industry and measuring, locks and measuring pricing and so forth. Have you found that it has brought companies that are dispersed more together and helped managers manage their origination staff, being able to give them hard data that they may not have had before?
They have, and the timeliness of it is something that we mentioned earlier, the actionable insight in a timely fashion. So if you're getting things that we can provide, locks in a real-time fashion, you can look at locks per LO, you can look at the granularity of it, where the locks are getting done. It is enabled our customers to dig in a little deeper. Before maybe it was looking a little bit more global, a little more high level, but being able to use the information at a granular level, I believe has helped them. We've gotten a lot of positive feedback with regards to the behavior, whether it be behavior in price exception behavior or behavior in the products that are getting pushed. That is enabled us to provide them with a little bit more insight than they might have looked to us for before, which has been a big benefit.
Good. Yeah, I've heard things. Like I say, the ability for managers to look at, say, real-time locks or whatever it might be. In the old days, whereas you would wander out to your, a cubicle nearby and ask the lock desk person, oh, how were locks today? Or they would come in the middle of the day, oh, it seems like it's heavy. We're getting a lot of phone calls or a lot of faxes coming over. I think what you've done is just head and shoulders above that. I mean, it's indicative of the technology that's out there, and you guys are right there. So congratulations on that.
Thanks. It also enables us. It was always the question of, you can make some internal decisions and you can look at internal metrics and think that, hey, I made a good decision, or I need to go a certain direction. But it's something else entirely to have that scope as to what the rest of the market is doing. And so it's not just looking at your own LO performance or your own lock performance. It's looking at and comparing yourselves to others. And you can make a pricing move and see a lot of positive reinforcement from that pricing move. You increase locks by 10%, but if the market increased by 20% and you don't know that, then you think you made this great move, when reality is you're actually behind where the rest of the market is moving. And so having the insight, not just for your internal metrics, but also the external, has been huge. Yeah,
I remember when I was running capital markets, and we had different products, obviously, and whether it was a 30-year or 15-year or 5-1 arm or 7-1 arm, whatever it might be. And the next day we would get a report from, maybe it was Icon, something like that, that says, oh, your company was ranked here in our survey on 30-year, and it was here on 15-year, and it was here on 7-1 and here on 5-1. And then you'd kind of analyze that and think, well, it's a little bit, that was yesterday, today's today, and you would adjust things accordingly. But this, like I said, this is so much more scientific and so much more real time. It is. So amazing. Let's track back a bit there, because you mentioned one of our legacy companies. We are Icon. So slowly over time, Icon was purchased by Informa, and we spun off and created Curinos as our most current iteration of the name. And so what's great is that name and the methodologies that you trusted before are just even better now. And having that legacy, those legacy relationships continue on till now. There's customers that have been in the fold for 25 years that are the same customers that we've been dealing with. And it's great to have those longstanding relationships. And we've had some shifts in the name, but it's still a great platform that everybody's pretty familiar with. Somebody told me the other day that they don't use thermal paper and fax machines anymore. I was flabbergasted. So, wow.
Started out of somebody's garage.
All right. Well, that's good to know. I appreciate that information. And
it was a great unintentional plug there, Rob.
Right.
That was.
Yeah.
And it shows my.
I was a customer for 15 years before joining the company. So it was nice to come in the fold. And as a practitioner, be able to provide that insight into kind of guiding the product in a certain direction to make sure it's most useful.
That does remind me that I need to get your information on my Palm Pilot before the end of the show.
Brandonn, you were out at IMB last week and interested in your take on it. One of my takeaways was just pricing strategy for leaders in the mortgage industry has never been more top of mind than it is right now for all the obvious reasons. They have, in most cases, operational staffs that are ready for more volume than they're doing right now. So it's like, how hard do you put your foot on the gas pedal in terms of, driving down and sharpening the pricing pencil to keep volume coming in. Also, though, lenders are recruiting loan originators like crazed maniacs right now. So, and obviously any LO that is interviewing with any company, that's sometimes they're not maybe asking all the right questions, but one question they're all asking is, how you pricing? Let me see your rate sheet. Let me see your levels today. That you're right at the center of this, right? Have you ever seen pricing strategy be more top of mind for leaders in the mortgage industry than it is right now?
When you're maxed out on capacity and you can't take another phone call, pricing strategy tends to get pushed to the side a bit. Let's just maximize everything, get as much as we can, keep the rates at a comfortable level where the volume keeps coming in, but you don't have to put as much focus in it. As the spreads start to tighten, as margins start to get thinner, it becomes even more important that you have a solid pricing strategy, that you're able to monitor it, able to make adjustments on the fly. I think with the LO retention, actually came up multiple times during my conversations as well, was the stressful component of it is it's not always just about what's on your rate sheet that day. So can you show me your levels? Can you show me where you're priced? A lot of times it's about strategy. I think being transparent. I think there's always been a history of capital markets and sales management, not necessarily being at odds, but not necessarily being fully transparent. I think letting sales executives understand what your pricing strategy is so that you know where they're going. It's not just, so now when they hear something that says, hey, our price isn't the best today, they can answer with, well, let me call capital markets and yell at them. Maybe that's because we're doing this, this, and this to strategically place us in the market and provide us with the most flexibility and the ability to get, volume where we need to. I think communicating that out goes a long way towards trust. And trust is a big component of that LO retention.
It's interesting, the point you raised there, because you can, if you as a lender have this information, what do you do with it? And does not only Curinos, but any vendor almost, what does that vendor do to help that lender make an action plan? So for example, going back to this icon survey that I would get thrown on my desk in the morning, and the CEO would say, well, we need to sharpen our pencil because I want to be in the top 3 on the 30-year fixed rate conventional conforming. And I say, okay. And I'd always think, well, but you're not, you want to be there, but it doesn't do anything about our cost. What if the top 5, what if the other top companies have a much lower cost to originate than our cost? So we're looking at it one-sided. So the ability to take the data like you guys are and say, not only here it is in terms of locks, but also possibly provide guidance and talk to them about what it means, and have that ability, I think, is very, very helpful.
And I think it's not just about the rate sheet information. One of the metrics that is most used by our clients is a weighted average market price. So if you're a member of our consortium, both on the origination analytics on the pricing side as well, then you have something that's called the weighted average market price, and it takes where volume's getting done and weights it by the share of who's winning the volume, and looking at that on a rate sheet level, taking that and then comparing it to the best price in your market. You can see some spread there, and where there's some room that says, hey, we maybe not have to be the best price, but we're in line with where business is getting won. I think when you're looking at a cost basis, it's very important not to chase everybody down the rabbit hole. That's the quickest way to go out of business. And setting expectations. One of the most challenging things is to understand exactly what your cost is on a variable contribution margin, so that you're not thinking that every loan is incremental. Oh, I've got to do that. Well, if you're doing that at a loss from a contribution margin perspective, then you shouldn't do that loan. So there are some decisions that you should make that aren't necessarily about bringing in as much volume as possible, but bringing it in at the right price.
Yeah. I was just on a Stratmore call right before this call, as a matter of fact, talking about customer satisfaction metrics. So you have, when you're dealing with a borrower or a client or potential buyer or home buyer, whatever it might be, not only do you have this pricing issue, but when you talk about product, price, service, being able to quantify the service side of things. So this obviously helps on the product and pricing side of things. And then there are tools that can be used to measure customer service, which really helps lenders complete the picture in terms of trying to get an upper hand on their competitors and, move forward, especially in this year. So
that also, that touches on some of the other metrics that, it's not just about price. So we have operational metrics that look at lock to fund, not just pull through, but turn times. One thing going back to an LO retention, you can show somebody, hey, our turn times are faster than the industry average. Our pull through is higher. So you're not just going to get paid on more of the locks that you make, you're going to get paid faster because you get paid after it gets funded. So those are things that you can use from an LO retention. They can use from a comparable. Do you want to beat the industry by 15 days from a turn time perspective? Or do you want to back off a little bit and say, oh, you know what, maybe I do have a little bit of room to give on that. And maybe we don't have to be as pressured or spend as much to get these turned faster. So those are all things that, as we talk about staffing, not just on the LO side, but the fulfillment side, what are the right staffing levels? Comparing yourself to your peers is one way to do that.
I was just pouring through the TMC benchmark data for December and noticed some things that were interesting. One was the average units closed per LO stayed at 4.8 for the month of December from November, but volume dropped. So that tells me, and what I'm hearing anecdotally, lenders are getting rid of their lower producing loan originators for all the obvious reasons. They drain on efficiency. And, just efficiency and profitability going forward is a big thing. And, you're left with a savvier base of salespeople. I think we talked last week on this show with Jody Hall about that. Her just talking about being out on the recruiting road and with their own internal LOs, like the types of questions that LOs are asking that they're recruiting or internally are next level, the better questions. And the point you made earlier that I thought was really salient was just being transparent with your pricing policy around with your existing LOs as a retention strategy, right? Because when volume is flush and refis are flooding in the door, it matters, but doesn't matter as much how you're priced. Right now, it matters a lot, and lenders are sharpening the pencil and taking a little pain. And was that your experience in talks with lenders last week? That is more of a strategy?
It's not, it's very hit and miss. A lot of it times it comes in with the revenue manager that owns it, maybe in capital markets, maybe in finance, and their willingness to share and, partner. I've always been a very, very strong believer in that. You mentioned one thing that was interesting, that the levels of loans per LO funded, even though volume was down. Another element of that, coming into the pandemic was that just the job losses in the market, but the amount of job openings in the mortgage space. Mortgage was killing it. We were record volumes and having to bring people on board. And as the economy has shifted, rates start to rise in the mortgage space, volume starts to trickle down. But other job opportunities, great jobs report this week, lines up with some of those people going back away from mortgage. Maybe they stepped into it for the pandemic and stepping back out of it and maybe into their former lives or a new direction can contribute to some of those metrics.
This is the Rundown with Rob and Rich. I'm Rich Werbinski with the Mortgage Collaborative, joined as always by Rob Krisman. And this week, Curinos, Head of Real Estate and Consumer Lending, Brandonn Dukes. Brandonn, jumbo pricing. There's no topic, I think, consistently in my 7 years with TMC that the members talk with themselves about more than, outside of maybe the general business climate, than jumbo pricing. Who are your jumbo outlets? Where can I find good jumbo pricing? It seems like nobody is happy entirely with their secondary market outlets on the jumbo side. And I think the biggest reason to that, and welcome your opinion here, is the depositories are doing a lot of that lending at aggressive rates because it makes sense for them as a depository to bring those customers on board. Jumbo pricing in general still below conforming, right? And would just, I guess, welcome any expertise you have or any thoughts you have on the jumbo market right now, maybe today, but also as we throughout 2022 here, some trends you may think emerge.
Well, I mean, a lot of the jumbo space and pricing that out it's just going to go back to the value they want to have and the balance sheet that they're looking to fill. Rates have gone up 50 basis points just since the beginning of Q4 in both the conforming and non-conforming space. Having said that, it's still a very attractive outlet for some banks to continue to put some stuff on their portfolio. As we shift to the affordability, and I know one of the things that you had mentioned in kind of a pre-meeting was just the housing supply and things of that nature, the pressure on house prices as they continue to rise. You're going to keep trickling in more and more, and the need for jumbo lending is going to continue to grow. And I think that is going to keep the product attractive, but are we going to have to see some shift from the fixed 30 down to more ARM products? Or are we going to get back into a really heavy dose of IOs on the jumbo space? And a lot of that's going to depend on who wants it on their balance sheet or the outlets that can be created in the securitization market to bring that to the front again. It's kind of been on the back burner for so long, but that's absolutely a topic that keeps coming up again and again.
The jumbo issue, Rich, is certainly interesting to talk about because people wonder, well, why is jumbo pricing better than conforming pricing to some extent? And of course, the quick answer is, well, you don't have the same loan level price adjustments. You don't have a 52 basis point G fee that's being implemented or put on it by the FHFA. The jumbo pricing, much more portfolio driven, and it's driven by those investors who have, certain cost of funds and certain appetites for assets to be on their books, certain cross-selling opportunities. The thinking that I'd rather do one $900,000 loan than three $300,000 loans from a cost perspective and frankly from a risk perspective, because if you do three $300,000 loans, that's the potential for three loans where some page 83 of the disclosure package wasn't initialed properly or something might happen. So doing one loan oftentimes is easier, but the jumbo market, primarily along the coasts, California up through Washington and then down along Texas and Arizona out to Florida and up the coast, leaves off a large swath of the middle part of the United States. So sometimes when you talk about jumbo, obviously it's not your Missouri lenders or your Kansas lenders or Wisconsin lenders so much as it is, the folks in the Northeast or the folks out in California. Now, granted, 25% of our business comes from California, so it's a sizable portion, but the portfolio market and the jumbo market, I think, will be very interesting given the recent changes in loan limits by Fannie Mae and Freddie Mac, driving some business away from jumbo lenders into conforming lenders if the pricing is better and if the program is there. So product and pricing will matter. And you're right. When I go to these conferences, jumbo is, it's almost fun to talk about. Who's got the hot hand for jumbo investors, and Brandon, you guys are able to look at once again, look at the pricing, see what's going on out there, and give managers a real time information in terms of locks and in terms of what's going on out there that they didn't have before. So it's got to be a value to, as you put it, I think your consortium, to have that information. Mm-hmm. Does it get more use than some of the other products that are out there?
The way people look at it and the way people can use it, it's not just about the rate sheet. It's about where the rates are coming in at. So looking at the lock rates and looking at where the product is. So you can see in near real time that, we are starting to do a little bit more on the non-conforming arm side. We are starting to see more IOs across the space and on the coast effectively. And a lot of this ties back to each other. A lot of it ties back to the affordability, the home price crunch, the supply in the market, driving those prices up, and needing to find product that people can still afford to get into the house. My daughter painfully is going to prom, and one of the themes is back in time. And so they had these statistics listed from 1980 about the average home price and the average income. And back then, the average income was just 2.5 times to get to the home price. And now we're looking at 5 times. And so that affordability, that extra stretch that you need is going to come in the form of available product. Am I going to get a 10-1 IO? Am I going to get a 7-1 IO? What can I do to get into just to get into that house?
There's all kinds of things going on audio visually here, at least on my screen. By the way, congratulations on, is it a live prom? Are people actually getting together in a dance hall and going through uncomfortable dancing moves and all that?
People are, and I just know joining in the prom dress shopping extravaganza was an eye-opening experience for me.
I think that's one of those internet things that go around every once in a while, like the worst prom dresses in history. There's some, or maybe it's bridesmaids dresses. I don't remember, maybe both, but yeah, it's not like she's going to wear it again, yes. Right?
No, but she has 2 sisters. So my only hope is that that they end up being the same size their senior year.
Brandon, one of the byproducts of the pandemic for our industry and the work from home movement that followed it is just more lenders than ever lending in more states. A lot of medium-sized lenders that are in all 50 states, very small lenders of ours that we just saw our members expand the number of states that they're lending in for several reasons. One, there was so much refinance opportunity going around, and 2, they have operational employees that they were hiring all across America. And one way we're seeing our members and lenders in general use data that they haven't in the past is on growth and expansion decisions. What markets do I want to go into? Where do I want to hire loan originators? Where do I want to forge referral business relationships? I know this is another area of our industry in the market that you guys are heavily intertwined with, and we welcome any perspective you have on just the changing market demographics that you've seen, if any, these last couple of years in terms of where lenders are doing loans, and maybe pockets of growth, and any other market demographic trends of note.
And you say that using that for expansion, previously looking at our data was always about where are we going to put our next branch. Mm-hmm. And now it's not about where we're going to put our next branch, but where are we going to expand on a centralized basis, or where are we going to expand to bring in a distributed LO in a particular market. And being able to see the information down to a zip code level, you can literally target those opportunities and see where the volume's coming in and the different types of products. Do you have a competitive advantage in a certain product that is popular in that area? And then that's an area you might want to think about pushing into. But our data doesn't show much of what we don't know. You have areas like Phoenix that are just expanding like mad. The DFW area itself has never seen growth like this. And then the coast are always, California is always, as many people are leaving California, that's still where a heavy component of the volume is coming from. So it's, we are able to see those things through the data sets, and it's a huge tool to be able to get in there and figure out, all right, where do we want to expand? And I think it's more than just that's where the volume is, but it's the kind of volume you're good at. It's the kind of volume that you want to do. It's the kind of volume you have takeouts for, or you want on your balance sheet that is really beneficial, because you're not just blindly going in and saying, well, you know, I'm really good at VA loans. If there's not a lot of VA loans being done in that area, there's probably a reason. There's probably not an eligible VA opportunity there. But if you can take a look and see where that growth is in particular products that you're good at, that's one of the things you can narrow in on.
And then the MBA, their most recent week application data report saw an 18% increase in refinances, despite the fact rates keep going up, and most people attribute it to, okay, these are the, oh crap, I missed the boat, I better refi now people that represent that jump in refi activity. But, you know, might see a couple more blips like that. But is there any refi left? I know there's a Black Knight and others put out stats that there's this huge refinanceable population still out there. But outside of people that need to take cash out, how would you classify the remaining not cash out refi opportunity?
I mean, cash out though is a pretty big proponent and push on that refi index. The refi fatigue, it was real. You hit on certain individuals, you can call them 17 times, and if they want to refi, you'd think that they would have already. I think what we're seeing from a bunch of lenders is just a learning experience. They've gone through and they've said, okay, traditional marketing hasn't necessarily worked in getting this person to refi. How can I shape the message differently? Was it dollar savings per month? Is it a no fee offer? So it's trying to pull from different components of how to get your point across, because there is still a big piece of the population that hasn't refied, that is still eligible to get pretty decent savings. And it's just trying to convince them otherwise. Another case of that is the nature of people staying put, or people moving out to areas where they think they're going to be for a while. And hey, do I want to lock in a long-term rate? Do I want to take cash out? And you're looking at a pivot point in the cash out space where if they did refi during the pandemic, first mortgage rates are going to get to a point where a cash out isn't going to be as attractive as, say, a home equity loan. And so they're trying to jump on this as much as possible. Lenders need to take advantage of this level of rates. It's still below 4. It's still very attractive historically. And what can we do from a marketing perspective to get the leads in?
Yeah, there's a definite the spike up in rates, and they've gone up a little bit more this week as well. It's creating, like, just in the mainstream media, the amount of columns I've seen this week about, like, hey, house hunters, like, act now or forget it, or columns about the refi tick up that we've seen and correlating it back to the rise in rates. There really is, in the broader housing market right now, there is this trepidation and a sense that, because of all the things we mentioned at the beginning of the show, a rip-roaring economy, a Fed that is set to raise interest rates 4 or maybe 5 or 6 times this year, that your chance to buy a house or certainly refinance could be evaporating. And of course, continued escalation in home values is playing into that as well. And really, I didn't think we'd be here a month into the year. It really is kind of crazy how the first month of 22 has played out.
But Rich, I think it's important to remember, and Brandon mentioned this or alluded to it, that a good originator it's just not a rate discussion. It's a It's what can we do to get the lowest rate possible for you now? Maybe we figure out how to bump up your credit score. Maybe we put more money down and get a lower loan to value loan. Whatever it might be, let's look at a 15-year, let's look at a 7-1 or a 10-1. What makes you think you want a 30-year fixed rate? So there's some very valuable tools that originators have, or conversations to have with potential borrowers, whether they're looking to refinance or purchase a place. And I think it'll separate the wheat from the chaff, as they say, in terms of the origination staff that's out there. And once again, being able to measure some of those things like Curinos does is a great, is a very, very good thing. So when you talk to anybody who's been in the business for a while, oh, I remember when the Fed, did this to the prime rate and went from, 17 to 19, whatever these old geezer stories are. People still want to buy homes regardless of interest rates. People will still want to buy a home if they're living in an apartment, 2-bedroom, 2-bath apartment, and they've got 2 kids. That's gotten old, and they've saved up some money. And whether or not rates are 2 7/8 or 3 7/8, it's up to a salesperson to tell them, all right, look, rates have gone up, and rates might go up some more. And here's the impact on your payment. Let's talk about the neighborhood that you want to buy a house in. Let's talk about the school district. Let's talk about why you want to buy a house. So it's just a different conversation that originators are having now with their clients. It was bound to happen, right? We all knew rates weren't going to be at 1% on a 30-year fixed rate mortgage. So interesting times, interesting year. It always is.
I have just a few minutes left here on the rundown with Curinos, Vice President of Real Estate and Consumer Lending, Brandonn Dukes, and of course, Rob Krisman. Brandon, any other market trends or insight you're seeing, your talks with lenders last week at the Independent Mortgage Bankers Conference that you see as relevant or of note as we take things into the weekend here?
Turn times are back down. They're down 12 days from their highest point during the pandemic. Purchase times are a little stressed. They've been kind of flat for a while now. So is it that capacity that brings it back in line with where it's traditionally been? And what are the levels from a volume perspective, as we mentioned earlier, about maintaining and what's a good fit for their business and the cost base that they have? Those are some of the biggest conversations that we're having right now, because it's all in anticipation of, well, if we're going to have 5 rate increases, that means volume is going to drop dramatically. When when rates go up, volume goes down. It's a cyclical business it's done that for a long time. And how do we make sure that we maximize this opportunity as it continues to flush itself out? Like you said, refinance activity increased 18% on the application index last week. That's something to be said. But the margins getting squeezed right now is going to put a little bit of pressure all the way around. Can we maintain good turn times, or is that going to slip a little bit as we try to right size our cost base?
Record low turn times in TMC benchmark in December. I think it was like 33.6 days. We measure it from app date to clear to close date. Dropped like 7 or 8 days from November, and that number's typically lived like in the mid 40s throughout the pandemic. So at the same time, operational efficiency at its poorest levels right now, for all the obvious reasons. Lenders are overstaffed, generally speaking, and volumes dropped off. So some interesting data from our benchmarking tool that backs up what you're saying. And as we take it into the weekend here, Rob, you Winter Olympics guy, or what do you got going on this weekend? I'm locked and I'm snowed into my house, so I can't really do anything. So what do you got going on
this weekend? I went to a Warriors game last night. That was a lot of fun. I'm gonna play some basketball tomorrow morning, and then actually next Tuesday I head to Florida. There's your tip off for where I'm coming from next Friday. And then the week after that, I'll be in the Midwest. So there you go.
And of course, TMC in Florida, in Miami at the Fontainebleau, March 19 to 22 for our upcoming conference. You can go to mortgagecollaborative.com to get more information on that event.
It's only a month and a half away.
I know we had a big surge of registration this week, almost up to 300 people registered. So really looking forward
I'll
to
see you
that.
there.
And yeah, fired up for that. Always great to see the network together in person. Brandon, you what do you got going on this weekend? You a Cowboys guy in the Dallas-Fort Worth area?
Not a whole lot to root for right there. If you didn't notice, we did not advance to the Super Bowl for the 27th year in a row. But
how is Mike McCarthy still got a job? I mean, he's got to have blackmail on Jerry Jones or something. I mean, just the look of confusion perpetually on his face is.
Can we bring back Roger Staubach? Danny White.
I wish. But it's actually a high school swim season right now. My daughter is really fast and had qualified for regions. But given the snowmageddon, that actually got punted to Monday. So actually have a relaxing weekend with no sports activities going on in the house. So that's probably put that to good use.
Brandon, my hat's off to you. I talked to parents whose kids are involved or were involved with swim meets. And that is a lot of time standing on a concrete side of the pool, cheering them even though they can't hear you. So
actually, I'm very loud. I've actually been told they can hear me underwater. So that's always good. And as they specialize and as they get a little older, it's not cheering a lot. Their 1-2 strokes is all they compete in. And so you're there for 3-4 hours and you're cheering for a minute and 3 seconds. So I know exactly what you're talking about.
Couple last items, Brandon, Curinos, you guys are doing a TMC Connect webinar coming up here next week. Yeah, on margin management. We dropped the link in the chat. Well worth the time investment there. Getting a chance to hear Brandon and his crew talk about all these important critical issues we've been talking about. Brandon, any thoughts on that webinar you have coming up next week?
No, absolutely. So February 9th, I believe 3 Eastern, we have Richard Martin and John Holste contributing to how do you optimize your price position? So some of the things we talked about today, effective margin management, and it's more than just communication, but how do you actually do it? Is some of the things that they're going to be touching on. So I'm pretty excited to listen in and participate in that as well.
Rob asked in the chat, somebody asking for prognostications on what the high point on the yield and the 10-year Treasury will be this year. I love to put you on the spot.
This year?
Give us, this year, 2022.
I'll say I'll say 2.5.
Yeah, that's right around where I would come in. I think it'll get worse before it gets better, but I was talking on Last Week in Mortgage Today, the show we do on Tuesday afternoon. I have a different lender member co-host with us each week. This week I had Michael Jones from Thrive Mortgage down in your neck of the world, Brandon, as co-host. One of the smartest guys. I just love talking with him. We were talking about servicing, trading servicing, and basically he said we're selling servicing all day because it has so much value, and through CRM and other technology, we are very connected to our customers without having the servicing, and we are going to cash that out. And I just thought it was a interesting outlook. And then the other thing he said too is how, of course, servicing has value right now because rates are high and they're expected to stay at these levels. But he said, how many times have we been here where we said, rates will never get back down into the 2s again? But talk about Ukraine, all this crazy stuff going on geopolitically. We could be at $1.25 on the 10-year 2 weeks from now. And it would be surprising, but not surprising to those of us in the mortgage industry, probably.
The active purchase market right now and how aggressive it is and how aggressive we expect it to be this year is just going to put a lot of rates on the books that it won't take a lot to hit another refi boom. It's not just those who didn't take advantage last time, but it's everybody that's getting put on the books, right now, that'll be eligible and that'll be in the money for attractive improvement. So I agree.
Remember, a year ago at this time, we were projecting like a 2.6, 2.7, 2.8 trillion year. Ended up being 4.8 trillion. So take all prognostications, including the ones from this show, with a grain of salt in this crazy mortgage industry. So, well, once again, another fun episode. Brandonn, really appreciate you coming on. Really appreciate the long-term partnership we've had with Curinos, and before that, Informa, Icon, and really appreciate the insight you brought to the show today.
Yes, thank you very much.
Thank you both for having me.
All right.
Rob, it's good to see you. Good luck to your Warriors over the weekend and your neighborhood hoops games. And to all of our attendees, as always, thank you very much for joining us live. A nice and growing live audience, and even more, I know, listen after the fact on podcast or on our YouTube channel. You can find us in both those spots as well. TMC Connect on Apple and Spotify podcast, where the majority of you listen. So, but until next Friday, have a great weekend, everyone. Stay warm if you're anywhere in the northern 2/3 of America. Take care.